But it came from the very back because UBS is here in front.
Oh,
You
okay.
had one. Oh, you had one.
Das ist hier Ponyhof.
The
Nee,
gold.
keine Angst. Aber yeah, please interact with each other.
Yeah,
So
yeah.
say something and you wanna. Good. So, ladies and gentlemen, thank you for coming here to our panel. Our topic today is Trump, wars, and commodities. And I think the commodity space is as volatile as for a long time. Not like it's really a market which was shaken up by Trump and by other things. And we want to discuss actually what's driving the markets, like different kind of commodities, and what's the outlook. And then I think in the end we will have like 10 to 15 minutes for questions from the audience. So if you have any questions during the panel discussion, please note it down, and then later you can, in the last 10, 15 minutes, please come into the discussion and join us. So we have 3 experts here. I would like to start with Kerstin Hottner. She's head of commodities and portfolio manager at Vontobel Asset Management. She manages 2 active commodity funds covering a broad investment universe. She joined Vontobel in 2016, having invested commodities since 2014, holds a master in science and economics, and is a CFA charter holder. We have Fabian Erismann. He's a partner and portfolio manager at Earth Resource Investments, Swiss boutique managing commodity funds, focusing on mining and resources. He holds a master in geology and an advanced master in economics from ETH Zurich. Has 15 years of hands-on mining experience from South African gold mines to Scandinavian base metals, and was leading Sika's global mining business until 2022. And we got Cosmo Sturge. He's director of market strategy, partner at Baker Steel Capital Managers, a specialized natural resource fund manager focused on precious and specialty metals miners, holds a degree from University of Exeter and a master's in political economy from LSE. He joined Baker Steel 2010 after working as a research analyst at Independent Strategy, a global macro research company. Right. So let's start with a commodity maybe where a lot of investors have in the portfolios, and that's gold. And gold has broken the mark of $5,000. It's really remarkable. And what's really remarkable also about the price movement is that the real interest rate in the US, which is like the interest rates after deducting inflation, is still clearly positive. So that's not common, because normally the gold price will move opposite to the interest rates. And with a high interest rate, actually, we would expect that the gold price would be depressed. So my question would be, can gold rise further? And is the negative correlation with interest rates dead? And beyond the geopolitical uncertainty, which is for sure a driver, is also the debasement rate, the so-called debasement rate a driver, which is that fiat currencies are expected to lose value. Maybe Kerstin, can you elaborate on that?
I would say the correlation between commodities and rates is not dead. It's just not visible in the price.
Okay.
I think we saw outflows of ETF holdings, of gold ETF holdings, after the Fed started hiking, and because investors will always be sensitive to rates.
Okay.
And I think this is also the major risk I see ahead for gold if we ever go from a cutting cycle to a surprising hike from the Fed. I think this is the only real risk that gold might fall in the near future. But obviously, rates are not everything. Investors go into gold ETFs, for example, because of the debasement trade, because of all these geopolitical risks, political unpredictability. And it's not everything.
But was it surprising for you too that the gold price has increased so much?
No, I mean, obviously we know where it came from. It came from central banks, so massive amounts of gold buying by central banks following 2022. And then additionally, ETF buyings that were dramatically rising last year. So like a double bid on gold. Right. From 2 sides, central banks and ETF flows, and that pushed prices higher.
Right. Fabian, the connection to interest rates, is that something you look at, or do you think precious metals actually behaving in a more like unstable way?
Yeah, maybe I would have loved the question which you asked Kerstin. Were you surprised that?
Yeah, very surprised. Yeah.
So, and you know, I'm getting asked that question a lot, and I'll tell you a little story. I started in South Africa in a gold mine, South Deep, for Placer Dome back in the days, 2003. The gold price was $490, and we had all-in costs of $440, $450, and it was a good time. You know, we made some money. I was a young guy, so And if someone would have asked me if the gold price would go to $1,000, would I believe in such a scenario? And I would say, no way, you know. How could the gold price double within 10 years, you know? And look where we are now. So it's all relative, you know. It's against what, you know? Is it against fiat currencies? Is it against broader asset inflation in general? So that would be my answer when you ask me where the gold price could be in 10 years. So I would not give you a number, but I would not be surprised if it's double.
Okay,
you know,
because of fiat currencies?
Because I experienced it. I experienced in a 5 times gold price, which no one expected, you know, and it's just because of devaluation of everything else, you know. So, and the other question is, something has seriously broken. If you look at real interests, which were always the guidance for gold price, the negative correlation against real interest rates, since the Russian and the Ukrainians don't like each other anymore, there is something seriously happening in the world. So, and I would have never thought, if you have such an increase in real interest rates, that you would have such an increase in gold prices. And I think it doesn't really matter anymore where interest rates of the US, of the Fed will go. It will really matter what real rates will do in the future. And I would not be surprised if real rates will be strongly, strongly negative going forward.
Right. Cosmo, so gold as an insurance against geopolitical uncertainty, is that the main driver currently?
I don't think so necessarily. I think investors often look for simple answers to what the gold price is doing, the fear trade or something like that. But actually gold today, when we look at it, it's driven by such a range of different drivers and such a diverse group of investors. Central banks are a great part of it, of course, but they're only really one part of it. You know, it's investors from high net worths around the world, family offices around the world who are buying gold for wealth preservation, protection against inflation, through to institutions, through to central banks. And increasingly, of course, those Western investors who've been staying away from the market for much of the last 5 years because all those signals, high interest rates, the US dollar being strong, told them this is not the time to be holding gold, actually now are maybe starting to come back, as we saw towards the end of last year through the ETF flows. So I think it's an absolutely, you know, amazing period, I think, for the sector at the moment. Also, what we see from the clients who we speak to at Baker Steel is very much the gold is being held a little more as a strategic investment rather than just purely a tactical point, as maybe it had been in the past. And, you know, we hear that from investors who, you know, are looking for that point to get in. You know, and each pullback so far has been maybe a little bit shorter and shallower than people expect. I think there's a lot of money still on the sidelines there waiting to sort of build up. That would be my view. And the corrections will happen, of course. You know, it's never going to be a straight line, is it? But, you know, I think that these corrections are going to prove a pretty decent entry point for a lot of investors into this space.
And where is the change of mind coming from investors, that they move back to the market, to the gold market?
Well, it's, of course, firstly, the outlook for interest rates, as you say, still remains an important driver for those Western investors. And I think when we look back at 2022, when I completely agree, the market fundamentally changed. You know, you had the war in the Ukraine, weaponization of the dollar, all of those points that were driving that de-dollarization trend globally. What's causing it now maybe to see more of these Western investors coming back is they looked before and they saw high interest rates, high dollar, that put them off. Now, of course, the dollar clearly is on a downward trajectory, has been for some time. Interest rates in the US, we don't know what will happen. I'm certainly not going to pretend to make a prediction on that, but if you're to trust anything which you think is coming out of the US at the moment, they're probably going to go lower. And we can all see by looking at the Fed funds rate of where it is today, it has room to go lower. You know, I think if you look at gold price and how it's evolved over time, in each of these interest rates hiking and cutting cycles, the cyclical peak for gold has always come after the Fed has completed that cutting cycle.
Right.
And in our view, and maybe others as well, we're not at that point yet. So I would certainly say we have more to come.
Okay. In the precious metal space, we also have silver. So Kerstin, could you explain to us like what is driving the silver price? Also because there's a big industrial demand, and that's also maybe making the story more complicated.
Yeah. Yeah, the scene, I guess, last year was set up for this perfect silver rally, because we had a lot of fear about tariffs on silver in the US. So what happened was all the silver in Europe and Asia went into the US. We had almost no inventory left in London. And so every time like there was a bit of ETF silver buying, like prices spiked up and there was the squeeze. And then we had 10% up silver, and next day somebody was selling and we had 10% down silver. From now on, I would be very hesitant with silver. So actually, we in our fund we are very hesitant now with silver. We are closer to benchmark now because of the industrial component. So we should always remember that 60% of silver demand is coming out of the industry, and 70% of global silver comes out of photovoltaic industry, and they are under massive pressure.
Okay.
They are under massive pressure to reduce their silver loadings, to substitute towards, let's say copper. And this will be a slow process, not something that is fast. But eventually, I think it will hit the market.
So there will be a decline of industrial demand for silver. You see that? Yeah.
Absolutely. And I mean, the price, that's the beauty of our commodities. The price is always doing its job to balance supply and demand again if there is a mismatch.
Okay, right. Fabian, we saw this huge spikes, as Kerstin explained to us. Where were the spikes coming from? Because the market doesn't seem to have an equilibrium. It seems like there's also no liquidity in terms of supplying silver if somebody needs to buy. So the price was moving a lot. Where was that coming from?
Yeah, I mean, you had the big volatility on the upside and the downside.
Exactly,
so I think we are now in the 6th or 7th years of a massive silver deficit in the mining industry. You know, we are not capable of producing more silver anymore. So we are, since 12 or 13 years, we have a stagnant production in silver. We have a very strong demand, and we have a very large paper market. I mean, every ounce of silver is times 100, 200, futured, hedged, whatever. So there's a massive speculative element on gold and on silver, much more on a relative basis on silver as well. And I think demand is real, but demand is real for every commodity in the future, because it's a protection against inflation. And I mean, the Indians know that because they're dealing with a deflating currency all the time, or an inflating currency all the time. The Indians by now have $3 trillion in gold. You know, every household is hoarding gold right now because they know what's coming. The Chinese are doing the same. And what's creating the big volatility is a very high demand from these Asian markets and a highly speculative element from the Western market. So, and will it stop? I think it will stop, because these short positions over the last 10 years have costed so much money. You know, and at some point, I think this will dry out, and we will see the real pricing of these precious metals of probably of all commodities that have a high speculative element, but it's really about the precious metals.
Right. Yeah, Cosmo, the paper market. So you're based in London. I mean, we have the largest gold trading there, a lot of future trading, a lot of derivative trading. What's the interplay between the physical market and the derivative market? Can you explain a bit?
Well, the physical market for silver last year was so tight, and I completely agree with what both of them have said. It's anecdotally, we were trying to buy some silver as a sort of prize award for an event we were doing towards the end of last year, just a modest silver bar to be able to give away, and it was virtually impossible to get in London. So I think that it was a real supply shortage, and that was certainly one of that reason for that squeeze. But I think all of us could see this, that it had got a little bit ahead of itself, and I think that, at Baker Steel, what we really do is actually mining equities. We're not involved in that physical trading market. And I think we'd certainly been a bit, you could say, early maybe in terms of some of the silver exposure we'd had, which hadn't always been a good thing. But yeah, I think last year really proved that silver is the kind of market that when it does hit these real supply squeezes, that it really does move quite a long way. I think the trick for investors, of course, which is incredibly difficult to do, is that timing, getting that timing right and adjusting. And likewise, we also trimmed our exposure, maybe not too much, but certainly taking some of the beta out of those silver positions which we had, and that was really our sort of response to that. But to echo it, though, I mean, we remain pretty bullish on silver, very bullish on it in that longer term. Where the price will end up in the short term, I have no clue. Volatility is at the moment very, very high, but you're absolutely right. We're in a phase here of a bit of price discovery for that next range of where the silver price will move up to. Because silver is very different to gold. It shares some of the same properties in terms of why investors hold it. But ultimately, of course, it is never bought by central bank demand isn't the thing for silver. But instead, of course, it has industrial demand. That's the sort of underpinning for it. But that is, of course, price sensitive and thrifting. I mean, industry has done everything they can to thrift silver as much as they can. And, I still think that given the level of growth of technology in the world and silver's application in high-tech electronics, actually, we still face a really strong secular bull trend as a result of that. But that isn't what's going to drive silver up to $150. That's going to be investment demand coming in that does that. So that's our perspective anyway. But no, we don't really work on the sort of physical trading side of things any more than that.
And just imagine, you have a silver price now again today of $90 an ounce. A good silver producer produces you the ounce for $10. You have such a phenomenal margin. So. And usually we used to say, at least in the industrial metals complex, when supply demand is really critical. But in silver, it is much better than in gold, because in gold you could say every year we mine about 1% of the gold that is around in volts, in gold bars, in jewelry, in coins and everything. In silver it's less so, because we have the industrial demand. But and in the industrial complex, we always said if you have such a high margin for a commodity, prices should eventually come down again, because supply will respond. But the supply in silver is not responding since 6 years. So supply is just really, really stretched. Yeah.
I will come back to the production side. Maybe in terms on a general, from a general perspective, the asset class commodities. So we had actually a good performance if you invested in a commodity index over the last few years. And will that continue? I mean, Fabian, do you think like commodities as an asset class in a portfolio is actually still working as a diversifier? Is it working from a performance perspective? What's your outlook there?
Yeah, it's funny. I mean, gold is the best asset class since 30 years.
It is, yeah.
And most asset managers at this conference have less than 2% in their portfolio. So if you would have told me that tech is a really good asset class, the tech companies and the Nasdaq is a very good asset class, and you would have 2% of it in your portfolio, everyone would laugh. So.
But a commodity index?
I think we have a few very good years for commodities in general ahead of us, and it will not last forever. There will be a reset eventually for monetary systems, for the debt, and once this is cleaned up, until this is cleaned up, I think we're going to have very good years in the commodity markets. Yeah.
Kerstin, commodity supercycle is the word there. Do you agree on that perspective, or do you think I'm more critical about that?
You can call it supercycle, commodities bull cycle, capex cycle, whatever you want to call it. I think there is a new cycle, and that started 2020. And I agree, every cycle also has its end in the end. Yeah. But these cycles usually last 10, 15 years, and we are only like 5 years into the cycle. I think it should always be watched or looked at as a strategic asset class. I'm not talking about 20%, but like 5 to 10% of a basket of commodities in your portfolio gives you a lot of things. Okay. It gives you inflation hedging. It gives you a geopolitical hedge. It's a good diversifier to equities and bonds. So yeah, for me, it's never a tactical play. It should always be a strategic.
But did let's say the properties as a part of the portfolio, did it change over time? Would you say it's more like it's different because the gold prices are volatile? Did the volatility change in general in the commodity market? What do you see there?
I would say if we don't look at silver, but at the rest, the volatility was quite muted in the last 1-2 years. I would say. Yeah.
Cosmo, what's your outlook there on the portfolio side?
Oh, I mean, we haven't seen a real commodity super cycle for a long time. It was the 2000s was, of course, the last real cycle for commodities. I think this time it is clearly different, and I completely agree with you, Kerstin, that we are in a new cycle here, but it probably looks a little bit different. But to me, commodities, they sit at the sort of nexus of some of these really big global investment themes that everyone is looking at, regardless of what you invest in. It's the new industrial revolution or renaissance, or whatever you want to call it. It's the industrial strategy around the world in terms of everything from tariffs through to supply chains. And then, of course, the macro side of things, the macro forces, which, of course, are driving gold and silver. So to us, that creates an environment where it's probably a little bit of a disparity in terms of performance, an unequal performance maybe between some of the commodities. And that's not necessarily to say electrification-related commodities will necessarily outperform. We can see that swinging both ways. Of course, battery metals have been a terrible place to be invested for quite a number of years, although that does seem to be changing a little bit. So that's how we see it. But I think also what really, and to your point, Fabian, I think is that we find it a bit it's a bit underappreciated how the mining companies themselves appear at the moment in terms of their relative valuations. I mean, the fact that gold mining companies, for as an example, they've had a fantastic run already, but actually those valuations don't appear stretched. Right. They're coming off such a low base here, and it's such an under-owned sector that, in my view, this has many more years, I think. And you can call it a super cycle if you want, but it's certainly a cycle. And I think we're in the positive portion of that cycle now, in certainly the first half of it, I think. And
maybe to step in there, like regarding the battery metals. I mean, when I look at the industrial metals in general, we see actually a very positive side. We have copper, we have other metals which had a very strong price increase because of electrification, artificial intelligence. We have this kind of cyclical upturn. At the same time, the battery metals didn't work out. Why was that?
Well, I mean, battery metals, of course, to anyone invested in the sector will remember that, back in 2021, there was the Inflation Reduction Act, net zero was going to be the big thing. And of course, that created a rush into this tiny sector of battery metals miners. And of course, that caused lithium prices to rise, nickel prices, everything did well. And then, of course, the froth all came out of that over the next few years because supply really just swamped the market, and particularly on the lithium and the nickel side. That is changing now. It's taken 5 years or so for that to sort of, it's not finished yet. It's still an oversupplied market and looks like it will be for some time, but there are signs of changes, signs of supply curtailment. And at some point, it will become an interesting sector again, because at the end of the day, battery technology is a big part of the new industrial revolution. Right. And to me, what this really highlights is the need, I'm sure you two will both agree, for active management in this sector. That just to buy, for example, a broad brush commodity index or an ETF of some way in this cycle probably isn't the best way to do it. And actually, you do need to have more of a specialized approach to making those selections, be it between the stocks themselves or be it between the commodities.
All right, Fabian, inside the industrial metals, where do you see the good parts and the bad parts?
Yeah, so maybe just a word on these very, very small niche markets like lithium, graphite, rare earth, mineral sands. Like there's a whole bunch. Half of the periodic table is by now are critical metals. And we always said, we are saying that for 10 years, as an investor, be very careful with these very, very small markets, because China has 100% of the pricing power. Most producers, a friend of mine has a small spodumene mine in Brazil. He's producing for one Chinese off-taker, and if the Chinese off-taker says, I don't like your product anymore, you're out of the market. So it's a tiny, tiny market, which is under 100% Chinese price control. And this is not a very good position as a producer of any commodity. So it's really a niche, and it's really something for specialists.
And it's not a real market then.
Exactly,
right?
yeah. So what we like are established good markets, large markets, good supply-demand fundamentals, good pricing, spot price. So like proper, mature markets. And I think the opportunities in these large, good markets are equally good then.
And that's copper, for example?
Copper is one of them. I really like the zinc market. And then everything related to energy. Right now, we are super bullish on oil and gas, for example. But everything that transmissions energy, produces energy, and kind of, produces what we really need. So
because of AI
energy.
And electrification.
AI is just another, just another factor in there.
Right. Kerstin, on industrial metals, where are you positioned? How do you position?
Yeah. Short term, maybe a bit difficult, because, for example, copper prices also at record highs, and then what usually happens is then demand response, and this is what we saw in Q4 in China when they stepped back from the copper market. But this is just a deferment. So eventually, as long as their export growth is as strong as it was last year and the year before, they will keep on producing EVs, solar panels, and so on. And they will need copper, so it's just a deferment, and eventually they will step back into the market and push it even higher.
Right.
Maybe, if I may, just a word on the copper market. I mean, the copper market since 50 years is growing at 3% per year. Corona did not really impact copper consumption, despite we had no, there was no travel, there was nothing. So copper consumption was not hindered even by an event such as the pandemic. So even if you just draw a straight line in copper consumption, as it has done the last 50 years, we still rely on very, very old mines like El Teniente, Chuquicamata, Grasberg. Those mines are 60 years old, 70 years in place. El Teniente is 100 years old. And we don't have these large, big mines that we have commissioned over the 10 years. And we don't even know if they are around in the next 10 years. So we rely on super tankers that are very tired. They're rusty, they're worn out, and they will reach their end of their life within your lifetime, within my lifetime, like in every lifetime in the people of the persons in here. And this is not a very good sign for a commodity we all rely on. And it's the same in the natural gas space and in the oil space.
And that's why there's not an effect of the price signal. If the prices increase, then the production cannot increase.
In the copper, it eventually could respond.
Okay.
I mean, there are copper projects that you could develop at the right price, but as it looks like, not at the price we have today.
Right. Yeah. What is about the production side there? Yeah.
Well, it's an interesting one because copper, I mean, we absolutely agree. It's an interesting place to be. And I think it's uniquely vulnerable, isn't it, the copper supply chain at the moment. And we've seen that over the last couple of years with the various supply shocks that have taken place. It doesn't take much. Only one thing has to go wrong at one of these, as you say, old rusty tankers to really sort of take, a couple of % off the global copper supply. And that, of course, for managers like us, is both a sort of risk and an opportunity, isn't it? Because that causes a supply squeeze in itself, pushing the price up, benefiting other sort of other producers in that sector. So it's something which we have really seen as a focus this year. But yeah, clearly copper, on the growth side, copper development. I mean, that's got to be a really key area for the coming years ahead. It's the one metal that we all know that we need, and the mines are vast things that are old, that take 17 years to develop now, due to all of the issues around that. And
it's much more complicated to build a copper mine than a data center.
Yeah,
Exactly. Yeah.
Right. Kerstin, on the production side, what's your outlook there? Like, will mines respond to the price signal? Do you observe this? Is that happening now?
Yeah, probably recycling will also get better. Maybe more development in the technology of like splitting copper from other metals, and then maybe even enlarging the life of these mines. I don't know how long you can still run them, but I think this.
Put more money, more investment in to let them run further, right? Maybe as a last question before we go to questions from the audience, energy market. So was already alert. I mean, the world needs energy. The oil price increased now also because of geopolitical tensions. Maybe Kerstin, like where do you see the energy market going? How do you invest in that? And what's about let's say the trade-off between like the new energy, the green energies, and oil and gas?
Yeah. So yes, there's definitely $5-6 in the oil price at the moment due to the geopolitical risks. The next couple of months might be tricky for oil because we just have a lot of supply from non-OPEC countries, and also OPEC is also considering increasing the hiking or reversing their cuts. But we will not have a lot of non-OPEC supply in the years to come. Okay. So there were a lot of projects ahead of the COVID times, and then they were all put on hold because oil prices were negative and a lot of activity was going on. And now they all come online at the same time. So last year and also this year. But I would say from 2027, 2028 on, we have maybe 200,000 barrels of more non-OPEC supply. And then, yes, we still have OPEC, we still have Saudi Arabia, we have UAE, but the rest is also at their limits, basically. So I think from 2027 on, oil price needs to rise in order to incentivize more supply, because demand is strong.
Did you have a target there? Like, I think any number?
I would see it back at 85, between 80 and 90.
Okay. Fabian, also like the ballpark you're talking?
No, I agree with Kerstin. What we closely watch are the frac spreads in the US, so I need to explain it. The frac spread, these are special crews that frac these modern oil wells in the US, which tight oil, unconventional oil. And they dropped from about 800 rigs to about 550 rigs now within a short period of time, because most oil and gas companies we have in the portfolio trade 1 or 2 times EBIT. So in 2 years, those are operational amortized. They have good free cash flow. There is no cheaper sector in the oil industry. And if you are a CEO of an oil company in the US, you look at your enterprise value or EBITDA and you say at a multiple of 2, my business model is not attractive to any investor out there. So what I will not do is invest in more growth and more production. So I will pay a nice dividend, I will buy back my shares, but I will not grow. And this is exactly what happens in the US. It's all privatized. There's no government production in the US. It's all private. It's publicly listed or private, and they do what they want. And at the moment, they are not investing. And the oil production in the US, which is huge, it's the largest oil producer, will rapidly decline now over the next few years. And this will have a tremendous impact on the oil market. And the prices will double, triple from here.
Cosmo, any idea on the energy market?
At Baker, we don't invest really in the oil market. It's not an area which we focus on. We're more focused on the bigger themes there, which I suppose is the energy security theme, and I think that's not going to go anywhere. You know, I think we're going to continue to see, on the one hand, that push for renewables, which of course creates its own energy security issues of reliance on those critical metals, as we discussed earlier, and their supply chains in China. But really geopolitics, I mean, it's clear that, you know, that's going to be one of the big drivers there, I think, that oil price. But no, I'll certainly defer to those two and their predictions rather than offer any of my own.
Right, so questions from the audience. Do we have any questions there? Yeah, please, here in the middle.
So in traditional finance, there was this debate how derivatives trading affects volatility of the underlying. So we've seen a lot of volatility in gold and the silver prices in the last few months. Do you see a structural change in derivatives trading on commodities? Does the extra volatility due to Trump wars create some kind of structural changes in how derivatives are traded on these things?
Right. Maybe Kerstin, maybe you have an opinion on that.
I think it's only so. Yes, I would say the future market can mingle with the price very short term, but I would say medium term. It's always about supply and demand, and it follows the balance of this commodity, and yeah.
Okay. So in the long term, you think really the physical side is more important?
Absolutely.
Okay.
I mean, commodity prices always have been volatile because in commodities, it's always about the marginal barrel, the marginal pound, the marginal ton. If this ton is not here, the price will rise indefinitely. And if it's here, if you have one barrel too much, the price will fall also accordingly. So
even negative, right?
Even negative, as we've seen in the COVID crisis. So the commodity market has always been very volatile because it's always about the marginal price. It's the same in electricity market. We had so crazy volatile electricity prices in Europe because it's always about the marginal kilowatt hour. So that's just changing. This can hugely impact the price.
It's not the fault of Trump.
Well, Trump is very good for commodities. So Trump was the good joker for obviously for the commodity markets, but it's not Trump's fault that the volatility is high.
I think on the gold side, it's interesting with gold is probably a special case, I think, in terms of the commodities, because I absolutely agree. I think gold has a couple of other new dynamics at play which have maybe increased that volatility. You know, I think one, of course, you've had the entry of some cryptocurrency firms into the market. You know, Tether, of course, buying quite a bit of gold for their stable coins. Of course, whenever we see more retail interest in gold via, of course, the growth of ETFs over the last few years, and particularly for silver, you know, that's where you really start to see a little bit more of that volatility as well. So I think gold and definitely silver are maybe slightly more prone to those periods of time where entrance into the market can sort of drive that in a way that they wouldn't do necessarily for other more traditional commodities.
Right. Yeah. Further questions? Yeah, here in the back.
Okay, so it's very
Wait for the microphone, please.
It's about rare earth metals. So you know that China have control on rare earth metals, and you are aware of it. It's very crucial for economic and for example, for even production of lasers in Switzerland. Everywhere you need Ethereum, neodymium, and other metals. So if you're aware about it, there is some strategical movement from governments or from investors to buy existing mines in Africa. Because my clients, like from Africa, they have already this mines possibility. They complain that the 3 years they tried to make investments from Switzerland, but nothing happened. They 1 month ask China investors come and buy everything. And now they say you're losing opportunities. China people buy everything. And you know, it's not just about money, it's about production of other materials. So you worry about it, first solution. Now, if China still give possibility to buy in stock, so to share, to have physical Ethereum, neodymium, like in stock, is there some possibility some do this stuff? Because it's very important. And second opportunity to invest now in Africa, you have still some rare earth metal mines to do it. It's very important questions in terms of investments and also security of production in Switzerland you have so much production of rare earth metals. And you have solution if China stops everything to do what you will do and what is your proposition about this. And also can be a very good investment if people have this, and in terms of crisis it will go 10 times 20x for sure.
Right, the security of supply chains is a very important topic there. Maybe Cosmo, what's your outlook there?
Absolutely agree with you. I mean, this is, when I said earlier that commodities sit in the middle of those big investment themes for the world today, clearly one of those is strategic interest in supply chains and securing those supply chains. You're absolutely right. China dominates the rare earth supply chain at the moment. 70% of mining, I think it is. It's 90% of processing and 94% of the magnets, permanent magnets being manufactured there. Africa clearly has been a region where a lot of that Chinese investment has gone into, but on the converse side of that, from an investor perspective, you've seen a lot of government actions in the West to shore up that Western supply chain instead. So, of course, the most obvious ones are in the US, where we've seen things like MP Materials being backed by the US Department of War, whatever it's called now. And also in Australia as well. So I think that's a theme which we're likely to see very much continue. I don't think that's going to go away, and it's a huge advantage for investors looking at this, of course, because what those deals with the governments mean and those strategic investments mean is, firstly, you're setting, you can pretty much set a higher price floor for those rare earth oxides compared to the spot price, which is, of course, set by China. And if that develops over time, I think that, and there's all on the processing and the downstream processing side as well, and how that develops, in the West, I think there are some significant opportunities there. It's something we look at very closely in our Electrum fund, which invests in that sort of portion of the market. On China itself, we don't really invest so much in that area, so I can't comment on the specifics. But I think that it's part of this geopolitical fragmentation of the world at the moment, as you can certainly see that certain regions, would either be slightly more influenced by China or by the Western governments there.
Fabian, would I be wrong to say that actually when the European and the US governments, they say, oh, we want to have this secure supply chain of rare earth, of critical minerals, that actually not much is happening, or little too late?
No, that's all nonsense. So I would never invest in the rare earth space right now. So because there's a massive oversupply of rare earth oxides from all over the globe. The best rare earth deposit is actually in Sweden, Norra Kärr. It's not going to be developed in the next 100 years because it's a very scenic location. But there are so many rare earth deposits globally, and they are producing right now, but they don't know what to do with their rare earth oxide concentrates, because Cosmo's rightly put it, over 95% of magnet production is in China. China has 40 years of advantage in materials technology, in smelting rare earth alloys, producing really high quality permanent magnets, because that's what you produce out of rare earth mostly. It's magnets for electromotors, for wind turbines, for all kind of motors. And it's a complete illusion that you will catch up to this 40 years of advantage. And it's a highly energy intensive process. It's quite a messy process. And I can't see any way how we're gonna, with our energy prices in Europe, how we can compete in metals production with China. And that's why it's a complete illusion. The only thing we can do is make peace, trade without barriers, like have very efficient trade routes like we used to do 10 years ago. So we need to get back to that state of affairs.
But how likely is that?
That's very unlikely.
That's the thing. I think you can't stop governments trying to do it.
That's very unlikely.
Kerstin, what's your opinion, Kerstin?
I think it's a world where you don't want to be dependent on commodity supply, so you try to secure that again, and that not only affects rare earth, that also affects oil, for example. So we would not have been at probably $65 oil prices last year if China would have not decided to massively ramp up their inventories. Like they were at 90 days of import consumption. Now they are at 110. They want to go to 150. They realize, they are massively dependent on oil. So they started.
That's because of the Iran conflict.
Also that, yeah.
And they have no oil they have no oil domestically.
Exactly,
in China.
Yeah, they consume 16 million, 12 million is what they're importing. They are massively dependent. So everybody starts hoarding now, and I think this is bullish commodities for the next few years, because we are moving from this, and you put it rightly, from this global balances to very regional fragmented markets.
Right. Further questions? Hey,
Just yes, you brief maybe about tokenization of its assets, but if you don't have time, I will personally speak because it's also.
Yeah, please come later to the. Yeah, absolutely. Yeah, here in the front. Wait for the microphone, please.
I have two questions. So, first question: what do you think about uranium? And the second question is: we're discussing oil prices going up, but and do you think if U.S. attacks Iran, they're going to go up or down?
Right. Uranium. Who wanna step in?
Uranium,
Any opinion? Yeah.
it's a fascinating market. You know, I think it fits all the sort of hallmarks of an interesting area to invest in commodities, in that it has that supply tightness, of course. It also has the obviously clean energy angle of being, you know, a technology which I think has been, you know, broadly recognized as needed. But most importantly for us, I think it has that same strategic angle which we see in something like rare earths, where actually government support, and you can see this in the US now in terms of a more favorable environment there for nuclear energy, is hugely supportive for those uranium producers. The uranium price itself, of course, you know, I think that stands to benefit. But for us as investors in the mining equities, you know, I think uranium is one area where we almost see that even though it looks moderately expensive already in terms of its pricing of some of those companies, actually we think it is probably still a good area to be in, certainly tactically over the next few years, as we do see that play out in terms of the strategic interests and how they support that nuclear industry. So that's sort of how we see it on the physical side. I think probably that's an area which.
Kerstin, how do you,
guys
as an
will know more
investor,
about.
how would you go play the market?
We don't look at the uranium.
Okay.
I think I leave this to.
Oh, fair enough.
Okay, Fabian.
Yeah.
I think the uranium market is an interesting one. It's also, again, a very, very small market. And I could not tell you more than 5 companies which are producing energy that I would personally like invest. And it's a niche market. It should not be more than 10% of your portfolio or something like that. But it's very interesting. I mean, uranium is a proven source of very reliable energy. And for me, a very important sign was the Finland guys now produced the first reactor within time and on budget. So it shows you can actually produce this within a reasonable time frame. The Chinese are doing it on a regular basis. And I think once we get back this knowledge how to build these reactors efficiently and cost effective and within a reasonable time frame, I think it's off to the races also for the uranium price.
And from an investment perspective, would you say you could buy uranium as a product, or would you more go into the mining?
Yeah, no, we only invest in mining equities, but there are a few ETFs on uranium. Sprott has one, Zürich Invest. I'm not sure if someone has a small one. So, but again, it's a very, very small market. Right. So if you are new to invest to the resource space, don't start with the uranium market. So that's.
And the second question was the oil price, right? Oil prices, yeah. So the effect of Iran, what would happen there? Like, what is your outlook?
Yeah, look, it will. But these conflicts they always have a very short-term impact on these prices. They snap up and then they snap back. So equilibrium is found then relatively quickly. I would not now overemphasize the impact. If the Strait of Hormuz is closed for months and I don't know, for a very long time, but I guess the Americans would not allow such a scenario. So I would not be too concerned about it.
Kerstin, you mentioned $85. Is that a long-term thing, equilibrium thing, or short-term thing?
No, a pure attack on Iran and then maybe a counter-attack, if you close your eyes for 2-3 weeks, then probably the oil price would have not moved. It only moves if really energy infrastructure is destroyed, you know? And the US will not do that in Iran. Why would they do that? And why would Iran close the Strait of Hormuz? It's a threat, and they use it as a threat because it's a very powerful threat. 20% of oil and oil products go through the strait. But in the end, 80% of the exports that go through the strait go to China and India and so on, and all their allies. Why would they annoy their allies? They're the only ones they have left. So they are not going to do that.
Right. Okay. So we got 2 more questions, and then I have to close. Yeah, here.
I actually think, you know, the whole AI and robotics and so on, energy as well, oil, photovoltaics. I mean, it's wind turbines. It's all kind of artificially steered to bring a lot of consumption. I mean, it needs a lot of efforts by kind of what is seen as bigger players to move billions and trillions into it, to make booms and high prices. But agricultural commodities is what 9 or whatever billion people eat every day. I think that's much more sustainable.
Interesting, Kerstin.
There is a huge, though I agree with you. I mean, we talk about metals and they were the stars in the last couple of years. So what about grains? They have been the laggard. But there is a massive political incentive to keep food prices low, right? We just had a 12 billion subsidy program again for farms in the US and then another one in the making. And we have massive agricultural subsidies in Europe as well. So, but this is this will blow up, this will backfire, because Brazilian farmers are already under massive pressure, high input costs, low grain prices, and they will blow up eventually, and then grain prices will rally at one point. Yeah, but it's a huge political incentive to keep them low.
The very young population in Africa, and I mean, it's a huge boom there, and I mean, people want to eat and want to eat better and more, and I mean, what people have in Switzerland and many other places, people want to have as well. I mean, China is already much advanced,
but if you keep uneconomical farms alive by subsidies, then you will have these grains until the subsidies stop.
Right. The last question was here. Yeah.
Thank you for this lovely presentation. It was very interesting. What do you think about deep sea mining and magna knolls? Is there a future market for commodities in this space? Thank you.
All right. Cosmo, deep sea.
Deep sea mining. There's always a question about deep sea mining. In short, yeah, I mean, it's quite a way off, I think, but it probably is something which, you know, every year becomes a little bit more relevant. You know, clearly, you know, the seas are a resource there, which I think governments, as they respond to all of the themes we've talked about today, both in terms of that security of supply chains, the scarcity, the supply shortages, you know, will inevitably look more at deep sea mining. From an investment perspective at the moment, I don't see it as being an investable thing for some time.
Fabian, do you invest?
No, I agree. We can't even mine effectively 1,000 meters below ground. I wonder how we're going to mine 5,000 meters below the ocean, not on the ocean floor, 5,000 meters below water.
Okay. Kerstin, any idea on that?
The price will make it possible in the end, maybe.
Okay, right.
Eventually.
Okay, one very last question. Okay, or comment if you like.
I have a view on palladium and platinum.
Okay, palladium and platinum. Cosmo, palladium, platinum.
We have been quite bullish on it. It was a driver of our fund's performance last year. Certainly the platinum price, I think, had it benefited really from a similar sort of demand story to silver, really, a dynamic there in terms of it's been in a supply deficit for the last few years. You've seen above ground stocks being run down, and then at the same time, you've also had a little bit of a demand surprise to the upside. And I think that's benefited it. I mean, I think it's in a strong position today, but yeah, I'd be a little bit more tactical about the exposure. That's how we play it in our fund.
Yeah. Kerstin?
Yeah, maybe be aware if you invest in palladium and platinum that also the industrial component is obviously plays a big portion here. And for palladium, around 80% of the demand comes out of the automobile industry. So internal combustion engines, and yeah, if you believe that we will all drive EVs eventually, then there's not a massive need for palladium anymore unless they find a new technology that uses palladium.
Right. Yeah, Fabian.
No, I love it.
Yeah.
Great. No, I mean, you know, EVs. The EV hype is mainly in China because, as Kerstin said, the Chinese want to divert from oil consumption because they don't have oil. So what they do is now produce as much, at least in mobility, they can divert away from oil. So they will produce EVs and they will look for other markets. So they will push EVs into Africa, but for EVs you need electricity. So they will push solar, they will push grid installations and everything. But I think in the Western world, the US, they will abandon the EV path. You know, it's like the same in Europe. We saw now many companies, Ford, they already cancelled many EV models. They said we're going to reintroduce combustion engine models, the same in Europe. So I think there will be quite a big of U-turn in Europe and the US. and the the platinum is just not here. You know, there are a few producers left in South Africa. Russia is sanctioned, and you have no supply. So the palladium price will probably go very, very high in the not so distant future.
Great. Before we finish, my very last question to each of you: what is the one single commodity you think is most interesting this year?
Oh, this year.
Yeah, only one, a single one. Kerstin.
Interesting in terms of the
however you interpret it. Yeah. Like interesting to look at, maybe.
Okay, I think it's oil. There is this bearish narrative around oil out there since 18 months, and it just has not happened that oil goes to like 40 or 50. And I'm super surprised or super excited to see how that develops, and eventually this bearish narrative will be over, and we will look at real supply and demand drivers again.
Right, Fabian, one.
I would have also said oil, but because Kerstin said it, platinum, palladium. Go for it.
Cosmo, one commodity.
Well, I should say something clever like copper, but actually for me it's gold. Look, I mean, gold sits at the center of all of these big thematics, you know, everything, the breakup of, you know, geopolitics, the fact that, you know, governments in the developed world really will find it incredibly difficult to exist in an era of positive real interest rates. And it's the world we live in. I mean, Trump is in the title here, and, you know, to use one of his favorite quotes, he who controls the gold makes the rules, right? So I think gold is going to continue to be the most interesting area. And of course, within that, the gold miners, in particular, those mid caps with the sort of the growth and the real sort of margin potential there.
Yeah. Thank you so much for joining us. Thank you.
Thank you.